Ladies and gentlemen, on behalf of Forster, Bowman, and Lefkowitz, welcome to the webinar. Today's seminar topic is the Modern LLC Operating Agreement, and our presenters are attorneys Gary Forster and Kathryn Jones. In the handouts section, you can download today's presentation and also a copy of our firm brochure. If you have any questions, please put them in the questions section and we'll go through them at the end of the presentation. If you request a certificate of attendance, it will be emailed to you after the session. And now, without further ado, I turn it over to our presenters, Gary and Kathryn. Take it away, folks.
Hello, thanks for attending today. We're going to walk through some key provisions of the Modern Operating Agreement. Several years ago, the LLC kind of took over front stage as the corporate entity of choice, and the operating agreement is the key document. There's no longer bylaws or shareholders agreements. That's become the operating agreement for the LLC. In many ways, there's really no reason to create a corporation anymore. The LLC is more protective. But the complexity of it, and we'll go through several examples of that, is that you can kind of do whatever you want now. So we're going to work through several provisions of what you might want to look for in an operating agreement, and we hope it helps you. Kathryn's going to start with the overview and a list of the topics that we're going to cover today.
Hi, everyone. Thanks for joining us. Here is our agenda. There are 6 items here that we're going to walk through. In the interest of time, we may kind of skim over item 4, but the full slides are available in your course materials. So we'll start with an overview. Part 2 is why you need one and also why you don't. The key provisions section is going to contain most of our substantive discussions, and we'll end on point 5 with the Partnership Tax Audit Rules, which are pretty much brand new. So we'll give you a little overview of how those work and how you'd want to tailor your operating agreements to address new laws under the tax code.
Tony, we've got the window covering our slide. If you could move that window up, I'd appreciate it. So go ahead, Kathryn.
Okay.
Sorry about that. A little technical issue.
I think the first question that we ask ourselves when we're asked to prepare an operating agreement is to consider who we're representing. So right in the middle of your slide, that's a key ask. If you're representing a minority member versus a majority, you're going to have a different set of concerns to think about in the draft. So that'll kind of be a recurring theme throughout our discussion here. In Florida, Chapter 605 is the operative provision of the LLC Act. And if you don't have an operating agreement, this will serve as your operating agreement. And to the extent that your operating agreement is silent on certain issues, you'll look for guidance in Chapter 605 to fill gaps.
So you have to be very careful. We refer to Chapter 605 in Florida, but every single state has its own LLC statute governing operating agreements, and the rules between both the managers and the owners, who are referred to as members. So if you don't create an operating agreement, the statutes will create one for you. Depending on which state you're in, that may work or may not work. And it will definitely not work if you're looking to include a detailed operating agreement with respect to what happens if somebody in the LLC no longer performs services for the LLC, they die or they quit. What happens to equity in the LLC? What happens if a member is sued? The issues that we cover in these operating agreements really try to handle everything that would happen in the business and also everything that would protect everyone from creditors of the other owners. And if you don't have an operating agreement, you're kind of randomly dropping yourself into the statute, which may or may not cover you.
As mentioned, one of the great aspects of the operating agreement is the flexibility that you have to kind of contract your own set of rules for the company. The statutes do, however, put a few parameters on there, and the citation in Florida is Section 605.0105, subsections 3 and 4. And those are kind of, the limitations on what you can do and what you can't do. On slide 4, we've put together a list of some of the non-waivable provisions that are in the Florida statutes. And these primarily deal with, you know, waiver of judicial dissolution. You can't contractually waive that.
That's a big one.
You can't really restrict or unreasonably restrict the ability to sue the LLCs, members or managers. And then the bottom two fiduciary duties of loyalty and care and good faith and fair dealing. If you alter those, they have to be within the parameters of the statute.
So one thing to keep in mind, we talk about making your own rules in your operating agreement. Some states have adopted the Uniform Limited Liability Company Act. What that means is there's a uniform commission. They wear a certain uniform. No, it's a commission that basically creates a standard statute that other states that the states can adopt, not other states. It's a commission. It's an independent commission that each of the states can adopt or not adopt. And what happens is each state either adopts it in whole or adopts part of it, etc. The problem is that there's always a push and a pull with these statutes. In other words, the Uniform LLC statute is very favorable in many ways to the rights of the LLC as opposed to the rights of a member, for instance. And whereas I would say, well, why would we create mandatory rules that you can't contract out of in an operating agreement in the statute? So what these are rules where you can't say, you know, if we agree we're going to change that provision because, you know, we all agree we don't want that. There are a few rules in the Florida statute, and it comes from this Uniform Act, that you can't change, even if you include it in the operating agreement. The biggie is the first one there, that waive judicial dissolution. Kathryn's going to explain some possible workarounds for that if you don't want a member to be able to say, okay, I'm done with this. I want my piece. I want out. I'm going to dissolve this whole thing. Even though you may have 10 members and you've got a successful operating company, but one is upset, they can maybe possibly move for judicial dissolution, and you can't write it out of the operating agreement. It's just something to keep in mind when you pick which statute you want to work on. It's this one here. No. Uh-oh.
Okay. Trying to advance to slide 5.
The button's not working.
We also wanted to kind of talk about what you don't need it for. The LLC operating agreement, it's not filed with the state to form the entity under state law. All you really need to do to form the entity with the state is to file simple articles or certificate of formation. That's what the Delaware calls it. Mm-hmm. And you don't need it to get a tax ID number. We're often, brought in after the client maybe either themselves organize the LLC or have their CPA do it and get it set up, and then we're asked to prepare the operating agreement for the client. So what you do need it for, as we mentioned, was to override the default provisions in the LLC statute.
Yeah, so if your client comes in and has formed the LLC in a jurisdiction that doesn't allow, for instance, you to change the judicial dissolution provisions of the operating agreement, whereas if they would have filed it in Delaware, Delaware doesn't mind. Or if you may have filed it in a state that says, I'm just making up an example, that a majority of members may always remove the manager. Well, now you've got a situation where you may have a manager that you don't want removed under any circumstances, and you may be in the minority. Well, if you formed it in the wrong state, that provision can't be changed under that statute, so you've got to refile in a different state. Something that comes up from time to time.
This slide here is the first half of 605.0105, and this really talks about the scope and kind of the breadth of the operating agreement. Again, 3 and 4 are going to limit what you can do, but by and large, you have a lot of flexibility. Again, just to recap, you needed to tailor it to your specific needs of your LLC and your client to alleviate confusion or uncertainty when somebody leaves, whether through death or just they just decide to quit. And then we'll talk later about minimizing deadlock and resolving that to hopefully avoid judicial dissolution. Key provisions. The first one that kind of overrides, in my opinion, most is the management provisions. Again, in Florida, LLCs are either member managed or manager managed, and the default is member managed. So unless your operating agreement states that it's member managed, you're going to be subject to the member managed rules apply unless you decide otherwise.
And we used to have a provision that talked about managing members. And of course, once you have a provision for a few years, everyone on earth does it for the next 10 years, even though it's been removed. So there's no more managing member. You're either a manager or a member. Think about it as kind of the difference between a shareholder and an officer or director. It's really independent. Overall, it's a good thing to be able to say, we're going to install a manager. It again goes back to the majority-minority issue. If you're in the minority and you just want this particular person to be the manager, you could install them permanently. They don't have to be a member. They don't have to be related to the members. They just have to be installed permanently in the document. Also, this is very, very significant when you use LLCs, not only in the business context, but in an estate planning context when you have like a family entity controlling the family assets. Well, that person may want to drop below majority, quote, control, ownership of the company, all the way down to 1% to move assets away from the federal estate tax, but still keep control, where everyone signs off that this is the manager and it's not going to change.
When we do that, we do draft language where you can identify a manager and they can appoint
and
the replacement.
even the manager may replace the replacement. Right. That's a good point.
Again, it's a good idea whenever there's a shift in management or control from an equity position to look at the operating agreement to make sure it still works for what's intended.
Mm-hmm.
Going back to the majority-minority issue, if you're in the minority and you're in a member or a manager-managed LLC, you may want certain veto rights with respect to major actions. Typically, major actions can consist of these four plus whatever the parties decide or to use to define the term major actions to include. So as a minority member, you may not be able to control what the company does, but you at least would have the ability to veto. And so in the operating agreement, you could carve out from the general rule of the managers control, certain major actions to give minority members a little bit of protection.
Exactly. You can make your own rules and limit what the majority can do. We have a situation now where a construction group is putting together an updated corporate structure. They're in a corporation, and we've recommended that they instead move to an LLC format to simplify the fact that they really want to be controlled by two people, and that those two people can appoint their replacement. It's a fairly large construction group, and what's happened, interestingly, is under the corporate statute, your rules are pretty much set out. So majority kind of controls, majority shareholders really control. You can install directors, for life or whatever. It really violates the statute, though, in some sense. It's I don't know if it works, but the thing to do is to convert those groups to LLC status, because the LLC statute clearly allows you to make your own rules in the operating agreement. In our particular example, for instance, we do have a 50-50 situation between the children of the founders. But for instance, now we have a new younger generation employee who's going to be issued stock options. So that younger person is really connected to one owner a little bit more than the other. So if that stock option gets exercised, even though we may put protections as to who's going to act as a director and officer, now we have one group, which is our particular group, shifting into a minority status, which is very dangerous. Whereas if they went to LLC status, we could retain the two-manager format, that those two managers are in there permanently. We wouldn't worry about issuing stock or getting diluted or these issues that come up in the corporate format.
Again, this, there are certain things that you can't, the members reserve the right to vote on, even if you have a manager-managed LLC. Here are just a few examples. Merger, interest exchange, or conversion, which are major transactions affecting the constitution of the LLC. And so those statutes, you'd have to look at those to make sure that whatever your corporate action you're taking or LLC action you're taking, you're meeting those requirements despite what the LLC statute, your operating agreement might say. One issue that seems to come up a lot is how do we amend the operating agreement when you're a majority owner and you're used to being a majority owner. It's sometimes a little hard for them to understand that once you bring other people in, they have to consent to amendments to the operating agreement. So both in the manager-managed and the member-managed LLCs, unanimous consent was required.
This provision actually came up when they were lobbying this because there was a couple of large law firms in Florida that had this format that was being promulgated constantly. I've seen it 4 or 5 times, where they would represent the majority, and there would be a provision in the operating agreement that said that the majority could amend the agreement. And no one ever understood like exactly how that would work. So if you have, you have a group of 10 people going into an operating agreement, and it's got this provision in it, like we could change this whenever we want, even though you don't sign. We weren't sure how you could enforce that because the operation of the LLC is governed by this agreement, and it also affects how the members are treated, how they're distributed funds, what vote they have. How could you have an agreement that you could amend at any time with respect to all of those aspects and it be enforceable? That's called what's called an illusory contract, where you kind of sign something, but the other side could change it whenever they want. So it created all kinds of problems for years, and I think that's where this amendment in Florida came
from. Moving on to the next key provisions, transfer restrictions. Again, most of the clients that I've worked with are closely held businesses, and they enter into an arrangement because they know the people, they trust them, and they want to work with them, and invest, a pretty good chunk of their assets into this company. The transfer restrictions are really intended to preserve that close-knit kind of aspect of the LLC, and so generally you'd want to include a contractual prohibition against transfers, and then you would carve out exceptions. So here are just some common exceptions that we've used and we've seen in our documents. One issue that I think is a nuance but is important is when you're transferring, where you're restricting someone's ability to transfer the LLC interest, you're also going to want to prevent an indirect transfer by limiting their ability to transfer the interest of an entity that may be a member of the LLC.
Yeah, it's a very big issue. We came across it a lot, and we have specific language for it. It's kind of a workaround for people who want to transfer their LLC interest. So if you have 3 members and 2 are individuals and 1 is another LLC, it should raise that red flag. Someone could transfer their LLC owner, which transfers the equity in your LLC at any time. That's bad for a lot of reasons, because you could have a partner you don't want, for one thing. Obviously, that's a problem. But the reason that the LLC restrictions are so valuable, actually, is because once you lock up your LLC and someone attempts to transfer, or someone is sued and the person suing the member tries to take or foreclose that LLC interest, it's not available. It's a great change from corporations to LLCs. A corporation is subject to the English rule against inalienability. It's not only hard to say, it's hard to understand. It basically means that if you start a corporation with 3 people, you can't say to someone under the 1798 common law rule that Florida adopted from England that they cannot transfer their stock. It's some odd rule from England that we adopted. So that's where all of these right of first refusals come from. You can read a shareholders agreement. It's got 25 rights of first refusals just in case, someone gets sued. We can buy you out. If you quit, we can buy you. The idea is that only arises because you can't say to someone, you cannot transfer. This is the deal. This is who's going to own this corporation and no one else. It's not available, so you have to do it through these rights. And then, of course, when you have the right, it triggers, and then you have to figure out what the purchase price is. It's kind of the standard corporate situation, which is kind of going away now. Now you have the LLC, which says, no, that's no problem. If you write in there that you cannot transfer, it is not available to you unless we all agree. That's it. It's locked up. It's a great change, and it's not only protective of your business operation, it's also protective of the equity.
That leads us into buyout triggers. Thanks, Gary.
Oh, sure. It was intentional. It was segue.
Okay, so general rule is you can't transfer unless it's okay under the operating agreement. The operating agreement would next set out the events that would trigger those types of options and allow someone to exit, but in the manner that's been approved and agreed upon by the members in the operating agreement. A very common scenario is that you have an employee of an entity, and the employee is also an owner of the entity, and when they leave, you want to be able to recover their equity, so they're no longer an owner. We have a common business model when we are dealing with physician practices where there's an LLC set up for the practice, and then there's a separate LLC that is organized usually by the same doctor group to purchase real estate, and the real estate is then leased back to the operating LLC. In that situation, if your physician in that case terminates employment with the practice entity, you're going to want to be able to then trigger a buyout under the LLC operating agreement for the real estate entity to avoid them to be able to basically ride on the coattails.
Yeah, it's a little complicated because you have to link, right?
Right, you
the
link the two.
To the thing. Yeah.
And a kind of an important aspect of a termination buyout is you want to have a solid employment agreement that talks about termination for cause or without cause, because if, let's say somebody leaves and it's not on the best of terms, it's very hard for the remaining members to swallow the fact that they just got terminated for cause and now we have to pay them something. So
that's right.
When we're in the operating agreement, you could provide for discounts,
for cause,
for cause and things, but you have to be careful in defining cause in the employment agreement so it's clear which set of rules you're going to follow under the operating agreement in doing their buyout. Additional triggers are disability. Divorce could trigger a buyout scenario.
If you do divorce, you generally have to have the wife sign.
Right.
And we're not sure whether that's enforceable under the prenup statute, post-nup statute. But it's generally a good idea to have it anyway because it just all this stuff really in litigation creates leverage. So if someone's quits or they were a problem or they created some kind of damage to the company and you need to terminate them, you at least want to be able to rely on language that says, okay, we were supposed to pay you $100, but because it was for cause, we'll pay you $50 under the language, and then at least when you fight about it, you take a pretty strong position.
Another potential buyout trigger, which is usually you want to address this when you have 50-50 ownership, is an anti-deadlock provision. And there's a little sample here on the slide that explains it. But basically, it's a fair kind of approach because no matter whether you're the offeror or the offeree, the same price is going to change hands. So the incentive is to, if there is a deadlock and everyone's equal in management, you're able to come to a price that either one can live with, depending on whether or not they're the buyer or the seller.
Well, there is, and we've come across this a few times, an advantage to the wealthier side, because what happens is it's a standoff. So I say, okay, I want to buy you out for $100, and then, you know, if you don't accept, you can buy me out for $100. But sometimes one owner has the $100 and the other one doesn't. So instead of having a kind of an equalized deadlock, anti-deadlock provision, it can favor the more liquid partner. That's the only drawback. It's hard to find a perfect solution to this anti-deadlock because you generally want to have something just in case people can't get along, because the litigation takes forever. But you have to care. If your partner is the one without the money, they'll likely be at a disadvantage. That's the only drawback.
And this also ties into the judicial dissolution statute we talked about earlier, and that, you know, in the statute, the court will give deference to a contractual provision to break a deadlock, and so you're actually may be able to thwart a judicial dissolution by going into the deadlock.
That's a great point.
And at least having negotiations and discussions as to potentially resolving it, short of a buyout. The next issue in the buyout is valuation. How do you set a value for the interest? You know, number one, we talk about a third-party valuation, which is probably the most accurate way to go, but it's expensive, and you may not, it may be cost prohibitive to do that. A second technique that we've put into our documents is in the operating agreement requiring the members or the managers, whoever has the authority to make the decision, to agree upon a value on an annual basis. And that value would then apply to any buyouts that are triggered in the following year. The advantage of this is that hopefully there's nothing on the horizon that would lead to price manipulation or jockeying, and it's one less thing to worry about if something were to arise. And then
if they miss a year, if they miss some period of time, let's say they miss 2 years, then you could force an appraisal.
Right. There are you know, formulas you can employ depending on what you want to capture as far as the buyout price. We've been asked sometimes to intentionally set the buyout price at a very low price to help it make an easy exit. So that could just be a net book value of hard assets, you know, excluding big assets like goodwill and real estate.
Typically, if you don't go with the non-compete and you do have, you kind of have just guys getting together, then, you know, it's kind of an easy in, easy out. They start it up like a medical type of medical law, whatever. And when they break it up, they all of the rules associated with them leaving are there. It's a small amount of money. And then if you do, by the way, as a side note, deal with the operating agreement or shareholders agreements with professionals like doctors and lawyers and architects, we always suggest that you even attach the separation agreement to the operating agreement. So like they already have all the terms of separation, who's keeping the phone number, where the letters go, what the separation letter says. That adds another layer. It's unrelated really to valuation, but I just wanted to put that in there because that's a great thing to do when you do these operating agreements.
The mechanics of the buyout, they're kind of summarized there in the next section. The buyouts can be optional or mandatory, again, depending on what the parties want from a business perspective. One aspect of a death buyout is life insurance, so you don't have a liquidity issue down the road. And typically when we set these up, whoever gets the life insurance proceeds would have a mandatory requirement rather than an optional requirement, because that's why you bought the insurance.
If you make the insurance mandatory, which is often a very good idea, then the buyout has to be mandatory. So you don't want a situation where insurance is pouring in to this person, and I'm not in the mood to use it to buy. So I mean, I guess it's kind of an obvious point, but that does come up from time to time. The buyout can be mandatory without mandatory insurance. So if insurance pays in, the insurance goes out to the widow or the widower, and if no insurance pays in, then it's paid over, usually typically a down payment with a promissory note. But if insurance is required, you don't want to be in a situation where then the buyout's optional. We just saw that on someone else's shareholders agreement. It just creates a lot of confusion.
And then Gary alluded to the payment terms, which can be negotiated up front. That way there's no surprises.
Yeah.
The next key provision or capital contributions, and we see quite a lot of litigation on this actually. A situation, again, capital contributions could be in the form of services, cash, or property. But we've seen a scenario where, you bring in somebody because they have the contacts and the business know-how and the acumen, and then you bring in the other party that has the money. But what happens if they don't perform? You're going to have an issue because they own interest in the company, but you may not have a way to divorce or separate cleanly. So we like to see, especially if somebody is going to be contributing services as their initial capital contributions, some specific benchmarks in the operating agreement that would trigger a default and buyout rights if they're not met. Again, whether or not, at the end of the day that's going to carry, you could end up in litigation anyway, but at least you're laying a pretty good foundation to be able to recover the interest so long as the operating agreement is clear as to what's required and you know when a default occurs.
Also, one thing that most people completely miss with these service for equity type, sweat equity type arrangements is that it's pretty important that the service person understand that there's probably going to be a tax impact associated with the contribution of services. So where you put money into an entity, typically taxed as a partnership or a corporation or C or S corporation, there's not really a tax event. You create a basis, tax basis. You take back your stock, no problem. But if you're putting services in, what's really happening? You're contributing your services, right, in exchange for what really the IRS would say is money. And then that money goes into the company. So that little step in the middle where there's compensation and there's maybe a taxable event for payment for services is typically ignored, and occasionally it can have a very negative effect on the relationship if there's an audit involved.
Right. So it's funny. I find that clients sometimes they can't believe that if somebody fails to contribute, they can't just take your interest back.
Yeah, they assume that actually we've had a lot of I don't say a lot, maybe 5 or 10 times, where someone will come in on a dispute and basically they'll say, we put all this money in, like let's say we got this property we wanted to develop, and this guy was going to come in, he was going to get rezoned, and he knew everybody, and he turned out to be like, completely without any skills at all. And now we need to take him out. Let's just take him out because he didn't do it. And it doesn't work like that. If you don't have provisions in the agreement, in Florida, it really doesn't work like that. You have to have the ability legally to remove them. Now, can you do it without an operating agreement or a shareholders agreement? Yeah, it's conceivable because it's like a breach to your agreement. But what was your agreement? It's usually not even stated as to what was required of them. That comes up a lot.
So we talked about initial capital contributions, and there may be an ongoing obligation, or it could be an option to provide additional funding or resources to the company. Sometimes I've seen operating agreements where there would be a requirement to infuse cash if the manager says we need additional cash.
Yeah.
But there's no consequence if you don't. So really, what maybe it was intended to be mandatory is really optional because there's no dilution or any consequence to that. So if you do intend to have a mandatory capital contribution requirement, the operating agreement needs to spell out what happens if somebody were not to fulfill their obligation.
Yeah, and it can be pretty complicated. I mean, on some of the larger deals, exceeding $50 to $80 million, where you may have a private equity fund involved, you may have institutional investors, you may have individual investors. You really have to go in detail through what's going to happen if we run out of money. So if we run out of money, what does it mean to run out of money, first of all? And then you should have a formula there. And then if we run out of money, can the managing member ask for money? How much more money can they ask for? And what do we each owe? Okay, what happens now if we don't pay it? Can somebody else pay it and take my interest? Or if they pay it, is it just a loan to me and I don't get any distributions until it's paid back? Just that provision alone, which can be annoying to clients, that provision alone can be 5 to 8 pages long because everyone wants their customized language.
Right.
Yeah.
Right. And then from the minority member standpoint, you may want to add language that requires some level of due diligence to maybe seek outside financing or kind of use capital contributions as a last resort. So there at least there's a little bit of research and analysis as to whether the company really needs the money and if there's another way to get it.
Right. Absolutely.
Okay, and these are just, again, what Gary had mentioned, some consequences to failure to make an additional capital contribution. Distributions, so we talked about money coming in, distributions, money going out. Here's the default under the statute. I think the simplest, what we usually see is your distributions are made pursuant to percentage interest in the company. But again, the operating agreement, you can get really creative in distribution waterfalls and preferences, to customize it for your business.
So I think the next slide actually covers
Right.
some detail. Yeah.
So here's a sample waterfall provision. Again, we have to, it's not a tax seminar really, but the preferential distributions would only be applicable to LLCs that are partnerships for tax purposes. There are limitations on doing these kind of customized waterfalls under the S.
Well, you can have a lot of C corp though.
Okay, as well, yes. So a waterfall scenario that we've seen, and I've seen this in the real estate industry in particular, is you may have a class of units that are going to get a preferred return, so they get paid first at some annual percentage, and that could be accumulated until paid. And the next step in the waterfall is to then, if there's distributable cash available, you can do a return of capital contribution proportionate to the member's interest, and then after that, if there's cash available, then you go and do a profits distribution. One cool thing about the LLC operating agreement is the ability to define distributable cash, and again, depending on if you're the majority or the minority, really there's a lot of flexibility in deciding what's available for distribution. For instance, your management could take into account reserves and certain things you want to set aside for a rainy day, for instance. So, there's the ability to, if the operating agreement is flexible, for the management just to not distribute because they're finding there's not any cash.
Yeah, that would favor the majority.
That would favor the majority.
And the minority might say, if you've got a certain amount of available cash in the bank, I don't really care how you define distributable cash. I want my money, because what happens is that's typically the leverage play, majority versus minority, is we're not going to make any distributions.
There's a little caveat on the LLC statutes. You can't make a distribution if it would render the LLC insolvent, either from a balance sheet standpoint or for the ability to pay debts as and when they become due. You could override the insolvency in certain respects, so long as, and this is the bottom bullet point here, where if your distribution would not render the insolvency from the balance sheet standpoint, you could go ahead and make a distribution. So that's kind of a neat thing.
You just have, you have to be careful with that insolvency. Oh, here's the fun part. No.
Okay, good. Okay.
Everybody's had their coffee.
Is everyone awake? We're going to gloss over 4 again. Those are in your course materials, but I wanted to reserve a little bit of time for the Partnership Tax Audit Rules, which is a new, basically it's a new partnership tax audit regime that affects tax returns for the tax year 2018 and forward. Interestingly, there are regulations that were just released by the IRS. I don't believe they've been published in the Federal Register yet because of the shutdown. It's 420 plus pages, so if you are having trouble sleeping one night, go ahead and pull those out.
Yeah, you have to memorize.
But really, it's kind of a seismic shift because, prior to the BBA going into effect, audits were under TEFRA. And under TEFRA, there was no ability for the IRS to collect underpayment of tax at the partnership level. The IRS had to basically try to collect the tax from the members, in the amount that they should have reported on their returns. Here, the whole purpose is to make it easier for the IRS to audit and collect tax. And so under the new rules, the IRS could assess a deficiency at the LLC partnership level rather than at the partner level. And then the issue with that is if there's a change in the membership between the year that's being audited and the year that the audit is occurring, you could have new members being forced to shoulder a tax liability of the LLC that they were not members at the time in the tax year at issue. So it really could be a disadvantage if you're coming in and you're being saddled with a tax debt that you may not have known about when you enter the LLC. So there's certain ways to mitigate this problem under the new rules. First, I think the easiest way to do it is to elect out if you can, and then you will be subject to the prior regime. The regulations set forth the opt-out criteria, and so we've listed them here for you. One important thing to remember is that you can't have a tiered partnership. So if your LLC is held in turn by members who are LLCs, you're not able to opt out. So the statute and the regs go into far more detail than we can go into in this seminar. But if you're able to opt out, if you are an eligible partner and can opt out, that's usually the first step you want to take. And again, that opt-out is made, the election is made on a year-to-year basis. So there may be a year where you qualify, and then the next year you have an LLC member that owns your LLC, then you may not be eligible to opt out that year. If you're not able to opt out and you're stuck and you're audited and there's a deficiency assessed against the partnership, you could make a push-out election. So the code allows the LLC to elect to push the tax liability out to the members who were members of the LLC during the year that's being audited. Again, these rules are very technical, and there are a lot of requirements that you have to make a valid election, but the regs would be the source of that information. And then if the push-out election isn't made or it's not available, then the partnership representative, there are other ways to reduce the company-level taxes and therefore the overall taxes that the members are going to have to pay.
And so the operating agreement would contain language referring to these things just to make sure that everyone was more or less aware, and then to the extent that you wanted to preserve anything in terms of reference or options, it really should be in the operating agreement.
Right. And again, here the majority-minority issue comes up as to you could set in the operating agreement, for example, the level of member consensus needed to make these elections, or the member of consensus needed to appoint the partnership representative and remove them. So there are ways to protect the majority or the minority depending on who you're representing when you're drafting the agreement. Another important aspect is how do you recover if the LLC pays taxes? How do you recover that from the members who really should be responsible for it? You can recover from the current members. There's by putting operating agreement provisions in that would require them to reimburse the LLC, or that would suspend their distributions and apply them towards the debt. So there's a way for the LLC to capture that money from the members who should be paying the taxes. Recovery from former members is a little trickier in that they may not have distributions to offset anymore. So you'll want a contractual indemnity provision in the operating agreement that at least gives you a claim to sue them for indemnity if, in fact, you're having a hard time getting them to pay up voluntarily. And it's also a good idea to have language in there that says just because you're no longer a member doesn't excuse you from your obligations that are intended to survive your membership. Another important aspect of the new tax audit rules is the partnership representative, and they really have a lot of power because, again, the IRS only wants to deal with one person, not 5 partners. And so the PR partnership representative is the sole point of contact with the IRS in an audit and has the power to settle the audit with the IRS to bind the LLC and its members. Point 2 is kind of a practical note in that although members can privately contract and agree in the LLC operating agreement as to how audits are going to be handled, the IRS is not necessarily bound by the provisions, but it's a good idea to have them in there. That way you can at least have some guidance on how to deal with audits. Again, the PR has really a lot of power to settle, and they also are the sole source of information coming from the IRS. So you probably want to have provisions in the operating agreement that would contractually bind the PR to provide information, to keep the members informed, to confer with them, and again, you could build in protections by requiring majority consent or unanimity with respect to major tax audit issues.
It's the guy that doesn't make the meeting, that last meeting. He ends up being PR.
And you can also, I mean, in number 5, these are some issues that you may want to consider in appointing a PR. They don't need to be a member. They could be, but you could have an outside
That's true.
partnership representative.
Or an accountant.
Or an accountant. And, one of the issues that you face when you are a member and also the PR is certain positions that may benefit you as a member, may work to the detriment of your partners, and you're kind of in that position where you may have
conflict.
an ability, to hurt them to your own benefit. So it may be a good idea to at least consider having an outside PR. Okay. And again, and this also, I think, what protects the PR is that if you have some level of member consensus, at least if something goes wrong, they're not going to hold the bag for making a decision that needs.
No, and there would be a release
right.
and indemnity of the PR just to make sure that whoever either knowingly or unknowingly volunteered to be the IRS representative can't say, look, I'm not going to incur liability for this. I'm withdrawing from this position. At least you could say, no, it's okay. If something happens and the IRS starts screaming at you, we'll pay you back and we'll cover your costs.
But again, as long as it was in good faith, I mean, there's, limitations on the ability to do that. Yeah. No matter what. So.
Yeah, you can't do anything wrong.
Well, intentionally.
Yeah, intentionally, right. We're getting close. That's it. Are we going to enter the question period?
Yeah, I think we're entering the question. We actually are a little ahead of schedule.
Yeah. So if you have any questions of any detail or just generality, let us know. We deal with operating agreements at really every level. We've written part of a statute in another country that deals with kind of what we envision as the ideal type operating agreement. Operating agreements, as I had mentioned at the beginning of the seminar, differ from jurisdiction to jurisdiction. I should say the statute governing operating agreements differ from jurisdiction to jurisdiction. So one thing that's come up as an item of interest as we're waiting for questions. Let me take a look at the thing. See these things here, like here is where you can see the question. Okay. So I'm not sure we have any questions. But anyway, what comes up is if you're in a jurisdiction that, for instance, doesn't protect member equity. What I mean by that is LLCs operate in such a way that, unlike a corporation where if one of the shareholders is sued on some outside matter, a car accident, another business, whatever, divorce, whatever, the corporate equity is just another asset. It's just like IBM stock, and that equity is just taken as part of that lawsuit, so that the remaining shareholders have to deal with having a new partner. LLCs, really, the principal difference is that that's not the case in general. So in general, if you have the right statute, if a member is sued on something unrelated to LLC business, the creditor cannot take the equity of the member. And that's the principal advantage of LLCs over corporations. So, for instance, there was a series of cases in bankruptcy which started in Colorado that said, if, in fact, your LLC is only owned by one person, right? They wanted to reach the equity. Basically, this person, Ashley Albright, a movie star, went bankrupt, and they wanted her LLC equity in a single-member LLC. And I'm sure most of you have heard of this issue with single-member LLC that started with Ashley Albright. So the bankruptcy court said, you know what? The Colorado statute really suggests that it protects all LLC equity, but we don't think that's what was intended. because if you don't have a partner, what's the purpose of protecting equity? The idea was no one could take the interest of the member in trouble because we don't want to affect the other member. There's no other member, then like who cares, right? So they gave the bankruptcy trustee Ashley Albright's membership interest. It was foreclosed. It was just another asset that went into the bankruptcy. This created a series of cases in bankruptcy, and then in Florida we have the Olmstead case, which exposes equity in single-member LLCs. So whereas some statutes allow foreclosure, some statutes don't, you definitely want to be in a jurisdiction that does not allow foreclosure. And then you want to be in a jurisdiction which says we protect the single-member LLC. So that's kind of the standard you're looking for domestically on LLC. In Florida, for instance, we had the case, and it disrupted the whole system because the actual ruling suggested that even multi-member LLCs were exposed. So they revised the statute to basically expose a single-member LLC. So in Florida, our single-member LLC is somewhat exposed to foreclosure. So for instance, in Delaware and Nevada, it's not. So the question becomes, if I'm in Florida and I form a Delaware LLC single member under the Delaware statute, and the statute says you cannot take the membership equity of a single member, right? And then that entity, right, operates in Florida or its members are in Florida. The member is sued, and a Florida court reviews, okay, you now owe $10 million. What do you have? Oh, I have an LLC, but it's Delaware, and it's a single member, but Delaware protects single member equity. Well, we're kind of 1-1. We're batting 500. Let's put it up. So one time the court said, we don't really care. You know, it was a bad actor, and she had actually formed a foreign LLC that was very protective in Nevis. It's under a prior statute. And they said, no, we're going to treat it like a Florida LLC. It's not a Florida LLC. We're going to treat it like a Florida LLC. And they took her interest. And then another time, what had ended up happening was the Florida action for collection, they went to Delaware, which was a mistake by the plaintiff, but they went to Delaware to collect on the Delaware LLC, and the Delaware court kind of punted on it because it was 4 years after the original cause of action, so that the statute of limitations had run. So that's kind of a closing note on why we go in general with LLCs. It protects the equity, but you have to pick the right statute, and in some sort of situations you even have to do more. So with that being said, I think we're at 55 after.
We're having a hard time moving the slide to the next one that has our contact information for questions. So.
Oh, Tony, can you move the next? Our technical guy is there. Tony, can you move the next slide down to the final slide? No, it just says, there you go.
All right.
Does anyone have any questions? So that's our contact information. You can send us an email or a call with any questions you may have. We can get you also the slides. If you'd like the slides, we can send the whole package to you via email. There was a way to contact us via the
I think there might be one here.
Okay.
Let me see if I can pull this.
It's hard to pull it.
Yeah. Okay, the question is here, do existing Florida LLC operating agreements need to be addressed with the new PR requirement and the other items mentioned? Yes, I would strongly recommend that. Again, this is kind of a seismic shift in how they do partnership audits. So we've been doing that for our clients. Anybody who's coming in for a new LLC operating agreement, and an entity was formed this year, or this is the first tax year, we would put those provisions in that discuss the PR's responsibilities to keep members informed. There's a member consensus thresholds set for certain activities and actions pertaining to the audit. And there is language in there that, you know, stresses again the importance of at least evaluating these various elections to help minimize the tax liabilities to partners who weren't really involved during the years at issue.